Good morning. It's Richard Calhoun with Creekside Realty, 40 years of working with buyers and sellers here in Silicon Valley. We're here today to talk about Silicon Valley real estate market. We're talking about week number 8. We'll come back to these URLs in a few minutes. This is the first data slide. There is supply, which is the blue line down here. That's how many available inventory there is available compared to the 5-year median. The 5-year median shows up at 100%. The yellow line, the 5 years I'm using are 2015 through 2019, 5 years before the pandemic. I should point out that those were 5 very strong, robust years. So the fact that we're having less inventory than we did in strong years is part of the reason why we're having the super strong market that we're having. The gray line is the number of new listings coming on the market. This is the exodus from Silicon Valley, if you want to look at it that way. It's how many people are selling, leaving, trading up, but the number of new inventory coming on the market has basically been right at 100%. What the real story has been is the red line, the demand line, and you can see that that is significantly above the 5-year median, and it's the surplus demand that we're having that's causing the shortage of supply. In fact, you can see here last year, at this time, we had basically the normal inventory. I will represent that if you went back to the first couple weeks in 2021, which are not on the graph, it was up here at 140%. So it's the surplus demand that ate up the surplus inventory. Then we had normal inventory. Then eventually the surplus demand continued to eat into the supply, reduce it to about 80%. Then later in the year, it continued to reduce the supply. We got down to 60%. We're a little bit above that right now at about 75% of the supply that's available. And this is macro data. This is Santa Clara County single family homes, San Mateo County single family homes, as well as condos and townhouses in both counties. So it's the demand that's causing the market to be so aggressive. Now what we look at is the single most significant indicator, in my opinion, days of unsold inventory. It's the ratio between the supply and demand. And now we're, instead of looking at a percentage, we're looking at the raw count in the yellow line being the 5-year median. So you can see that normally the DUI comes plummeting down the beginning part of the year, plateaus, and then starts rising up again as we get later in the year. But when the DUI starts raising up, the prices are already been increased. That's what's going on right now. Because this dip down in DUI makes it more aggressive, that's what causes the prices to skyrocket every basically January through April. And that's generalizations. There are fluctuations to what is our normal cycle in real estate, just because of outside influences and everything else. But you can see DUI is down here. It's basically at records lows. It's lower than it was last year. And that means the market's more aggressive this year than it was last year. Moving on to the sale price over list price ratio of each line, it is very noteworthy now. Remember, the dotted red line here is the best month ever, April 2018. But if you look, you now have 3 lines that are basically equal to or exceeding. The gray line probably exceeded it because the top part was above, the bottom part was right on, except for a short little section. And that was 3 weeks ago, February 14th. Call it 2 weeks ago if you want to count this as 0 weeks ago. Then you go back 1 week ago, the 19th, and we were better than the 12th. And now we have the 26th coming in essentially the same as the 19th. It's a little bit lower down through here. So people that are just going a little bit above asking price aren't have to being as aggressive. But at the top end, they're being more aggressive, and that tends to populate down. So I would actually think that we're going to continue to see this line move up. I don't think we're going to see as drastic an increase that we saw in the last couple of weeks. And part of the reason we're seeing this dramatic increase isn't changes that happen right now. These are closings that typically take about 5 weeks. So if you start on January 1st and you go 5 weeks, you're February 4th, then you're reporting on February 4th data 7 days later on the 12th. And guess what? This is just because we're now looking at the transactions that were negotiated in 2022 versus the negotiations of 2021. Back here, 4 weeks ago on the 5th of February and earlier, you're dealing with a lot of transactions that were negotiated in December, going back even further into November. Now with these 3 high record numbers, they're the bulk of the transactions, because some escrows take longer, the bulk of the transactions were negotiated in this current year. Moving forward, I moved the slide up. It made more sense to talk about it here. This just gets rid of some of the clutter and shows you the 12 weeks. So you can see 9 weeks were clustered pretty closely down here, and then you can see the last 3 weeks jumping out. And part of the reason I'm saying it's 3 weeks is there's 3 lines, and even though we're reporting the data right now, this is really what happened last weekend on the purple line, because the offers got accepted, and then because we're looking at sale price, it's 5 weeks past last weekend. So it's really 6 weeks ago is the first time frame that we have any data from. But again, there's not much difference here. Now, this is important because it starts showing you how the different market segments perform differently. In Santa Clara County, we only have 60% of the single family homes that you'd expect. You go up to San Mateo County and you're 93%. You go over to condos, Santa Clara County is at 102%. And you go to the Bay Cities of San Mateo County and there are 251%. I have had some issues with my condo data. I am going to try to make time to get in there and look at it a little bit. I'm getting more confident in it, but the inventory I still have the biggest issue with. I think the problem might be with my base 5 years. So it takes a little bit of time to go back and look through 5 years of active inventory and find out why the numbers are so much different. Then you go over to DUI. Again, there is some variation. It's also noteworthy that the hottest marketplace right now is those Bay City condos at only 11 days of unsold inventory. So condos in San Mateo County are now outperforming any of the other 3 segments. Then they're followed by San Mateo County single family home, then Santa Clara County single family homes, and then Santa Clara County condos. San Mateo County historically has outperformed Santa Clara County. I have a funny feeling this is more just a statistical fluctuation, but that's typically what you see. It is rare to see condos outperforming the single family homes. It clearly is happening right now. At least that's what my data indicates. And again, it happened a little bit last week at 15 days. It's a higher number, but it's still the lowest out of last week's data. And the 40 to 80 is what I consider to be a normal market range. Normal market data here is going to be different for each segment. It's 95 to 115, but it's in the black font to indicate the type of market conditions you'd expect based solely on the inventory. And in the Bay Cities, based solely on the inventory, you'd expect to have a cool marketplace. DUI is the ratio, which is more important. All of the market shares are red hot, which means they're in a seller's marketplace because they're below 40. Now you're looking at the same thing. You move over to the sale price and you bring in the amount of overbidding, because this really starts giving us an idea of how much pressure the buyers are feeling on making an offer and how high do they have to go to try to be attractive to the seller than their asking price. So this is how common the overbidding is. And it is unusual, but both these numbers are identical. It's not me pasting the number twice accidentally. The raw data showed that both were identical, which statistically would happen occasionally. Condos are a little less aggressive, but they're coming up there at 75%. Anytime 75% of your sellers are getting more than their asking price, you have a hot marketplace. Then this is records. I mean, we just shot through everything. We're up to 116% of the overbidding, 115% for San Mateo County, 109% and 108%. But here you can see each one of the components. You can see the buyers are being pretty aggressive. And this is appreciation since the calendar year of 2020. I took all the transactions that occurred in 2020, calculated what that median was for the entire calendar year, and then this is the current appreciation over that amount. So you can see Santa Clara County single family homes have gone up 31% in less than 2 years, because the median close of escrow date turned out to be about the first week in August. So we're not there yet. So in less than 2 years, you saw a 31% increase. In San Mateo County, 21%, Santa Clara County condos and townhouses, 17%. Bay cities are pretty cool at only 3%. Now, a couple of weeks ago, maybe even last week, that was a negative number. So you can see there's a bit of fluctuation in the data. And it was up to 16%. These are the peaks in the past. So these condos are not back up to the peak, and neither is San Mateo County single family. The only one that is Santa Clara County single family, and it's exceeding it by quite a bit. With that, I'll go over this as you come up with any questions you might have. These are, the green is what I call my root URL. If you go to that, you get to my YouTube archive of these sessions. If you you add in the 2022 for the year, you get to the live presentation Saturday morning, which I would encourage you to do. The handout is posted. You add in the letter H for handout 2022, the month code, which is 02, and the date code, which is 26. Then we already talked about the YouTube. To get to a specific episode, you put in the root URL and the 8-digit year, month, date code. And then if you want anything in last year, you have to use a different root URL. So with that, I'll pause and see if there's any questions. Not seeing any questions, I'll move on. Here we're looking at color coding of the different areas. So these are the different micromarket areas. You start off in Santa Clara County single family homes, then San Mateo County single family homes. The counties are at the extremes and are dotted because I don't have a color associated with that. And then you go into condos and townhouses in the different area. And I'm not missing the color down here in the San Mateo County North area. It's basically a very, very light shade of pink from 42.5 to 77.5, I think, is white in color. We'll see that later on. I don't remember those exact numbers. And then you have the frequency of overbidding. Look how high these are. Cupertino, Sunnyvale, 97%. But I mean, 94% in the moderate priced areas. Campbell, Santa Clara, Willow Glen, 92%, 93%. In the lower affordable areas, Milpitas, Blossom Valley, Santa Teresa, Berryessa, East San Jose at 80%. These are phenomenally high numbers, and it's hard to do better than that. San Mateo County's right up there all in the 80s and 90 percentiles. Condos are not far behind, 65 to all the way up to 90%. And the coloring through these first three is consistent between condos and townhouses. So you can go directly up because, frequency of overbidding doesn't get impacted by the type of property. The magnitude of overbidding is very strong. This is the highest number we have, and this is the number that plots out at 118%. And I had to change the graph, so I think I went up to 120% to plot the data. In Santa Clara County, these are numbers that have jumped up fairly significantly. Condos and townhouses now are in the high 100s, almost all at 110, not quite 107 basically. Now, on the pricing is assigned by the middle numbers, the median, and that's what assigns the color. Here I do the county data in thousands, which is why the K. The micro markets are in millions, and I do the difference units to make it stand out. County data doesn't have a color assigned across because on my maps, that would wipe out the whole county. So the bluer the color, the more affordable the homes are. And home prices are consistent, condo prices are consistent. With condos, the most expensive area is white, and then I just go down bluer. I did that, because clearly they're more affordable, but I didn't want to do two sets of color because, there wouldn't be that much gradient. And basically the number on the left is lowest 10 percentile in any given area. The number in the middle is the median, the 50 percentile, and the number on the right is the 90 percentile. So I'm looking right now at the moderate priced areas. So basically in the moderate priced areas, 80% of the homes are between 1.5 million and 2.5 million, with the midpoint being 2 million. Now we're looking at over time. We're looking last year and this year. We're looking at basically a 52-week period of time. We draw the vertical purple line where the week split is and add a week. So in 2021, week number 9 actually plots out as week number 10. So even though this is plotted at week number 10, that's the very next data point. And I do that so the lines don't connect to each other. It's a little confusing, but I can't subtract one from my x-axis, which is what I'd really like to do. I'd like to separate the two lines. So the concept is the same as you're looking at the yellow line, which is the 5-year median. This is the number of new listings coming on the marketplace. So you can see this year it's been tracking exactly where you'd expect it to be. And basically all last year, it tracked exactly where you'd expect it to be. So the number of sellers are not any greater. There was a fair amount of hope in the industry. More sellers would sell with the Prop 19. But in the local Bay Area, so many sellers are so far over their cap, they're not willing to pay the capital gains. So they're staying put now, not because of property tax, which initially held them in place, but they're holding put now because of capital gains tax. Here is looking at the number of active listings. Now, my definition of active listings is a little different than most. Mine is without an offer. A fair number of people, including the multiple listing service data points, include some of the offers, the ones that the listing agent wants the property to be shown for backup offers, as available available property. They're not available. A buyer can't go in and buy that property. The buyer wants to buy a property this weekend. Those are not viable options to them because the first buyer is most likely going to close on it. And if they don't, you don't know when the buyer will back out, and you're not going to come off the market several weeks hoping that the buyer backs out, which only happens about 15% of the time in a hot market places like this. It's a lot less. So my inventory is going to be lower than everybody's inventory, but my two lines are consistent, but I believe mine's more reflective. So normally at this time of the year, you have something like 1,300 listings of available listings, and now you're not even at 1,000. So we're more than 300 units short of where we should be. 300 units on 1,000 is a fairly significant shortage. You can see that last year, basically at this time, was when we were reaching the exactly normal number of inventory you'd expect to have. And then by week 17, we were starting to lose inventory. And by week 17, it's really week 16 because you got to subtract the one. You were below the amount of inventory you'd expect to have. And that's again because of the surplus demand. This is the number of new offers coming in. And if you look at this line, basically the blue line, the current data, is above the 5-year median, the data point where you'd expect the line to be. Or I'll point out that here it was actually a little bit below or equal to. That's just a calendar event. This year, just the way the calendar fell, January 1st was on a Saturday. My week runs from Saturday, believing that a lot of the real estate activity happens over the weekend, even though it's not reported until later the following week when the sellers are willing to accept the offers. So because this was the first week was essentially a holiday weekend, got impacted by the number of new sellers coming on the marketplace. You were essentially still in the holidays. For example, for the first was Saturday, the second was Sunday, so Monday's the third. So from the 3rd to the 7th, when I'm reporting the data on, there wasn't a lot of activity for the previous weekend because it was New Year's. People weren't out looking. So you'd expect the number of new offers to be lower. So it's basically delayed by a week this year. So now we move on to days of unsold inventory. Days of unsold inventory is the single most important indicator. You have Santa Clara County single family homes in the red, you have San Mateo County single family homes in the brown, and then you have condos and townhouses in the yellow. So you can see 2020, we started off with a normal year, Christmas slowdown, the market ramped up. Then COVID was announced, the market put on its brakes, very rapidly turned around and improved. Then the balance of 2020, the market continued to improve. You had the Christmas slowdown. 2021 was an aggressive year. We started off low and we stayed low. And at the end of the year, DUI went down instead of traditionally going up. So you had the Christmas bump this year, but the magnitude was much smaller than you typically have. And now your DUI is starting off much lower this year than it did in 2020, for example. So we thought we had a strong market in 2020. The DUI for Santa Clara County was somewhere up here around 35. Now you're starting off the year with DUI somewhere around 18. That's a significantly different marketplace. That explains why the magnitude overbidding is so much higher at 118%. Now we get into the map distribution. Here's where I plot out the single family homes only, doesn't include condos or townhouses. You have the different micro market areas, and this is your days of unsold inventory. The redder the color, the hotter the marketplace. And from 42.5 to 77.5, I basically say the market is a balanced marketplace. That's basically 2.5 days in from my artificial 40-80 thresholds. I could have done 40-80. The math worked out better using 42.5, and won't go into all that details. Your hottest areas are down here now, probably in Cupertino, Sunnyvale at 12, but I mean, Milpitas and Blossom Valley at 13. Then you go to the Bay Cities at 14. I forgot about Foster City at 9, very small micro market area, so not many people are in there. Then up to East San Jose at 16 days, and then things just fall into place, 17 days, 19 days. You're starting to get some slower days here at 28 days and 22 days, and finally 58 days, but even 58 days is a strong marketplace. But the concept is the redder the color, the hotter that geographical area is. Now you're looking at the frequency of overbidding, and you can see in 2022, we're up here at basically 85 to 90% of the sellers are getting more than their asking price. That's up significantly from the 75 to 80% that we were at for most of last year. It may not sound like much of an increase, but the higher you get to 100%, the harder it is to go up. It's almost like this should be on logarithmic type scale paper, but this just shows you over the time. Again, the purple vertical line is the separation between 2022 on the left and 2021 on the right. If you're in 2021, you have to subtract a year. So week number 9 plots at week number 10. This shows the frequency of overbidding over time. You can see the slowdown going into the pandemic announcement. You can see there was some hesitation, even though the speed of the market came back. There was some reluctance on the buyers to overbid dramatically, but they got used to it. And in 2021, we took off. And now we're starting at this high level and we're going up. Look at the steepness of the increase in San Mateo County and in condos and townhouses. You can't go over 100%. So I know we're not going to get over 100%, but it's getting up there. Now we're looking at the overbidding frequency geographically. Again, the concept is the same. The redder the color, the hotter the marketplace. If there was any cool areas, they would be in blue, but I'm keeping my definition of from 15 to 33% of the sellers getting overbid being a cool marketplace. Because by a cool marketplace, it's not cool relative to the hot marketplace. It's cool relative to, is the buyer have the upper hands in negotiations. So when the market graphs are red, the seller has the upper hand in the negotiations. When they're white, you have sort of an equal balance between buyer and seller. And when they're blue, it favors the buyer. And in Santa Clara County and the whole Bay Area, we're in red more often than not. Here's the increase. And I guess I wasn't remembering the number quite as high. The of our bidding is 16%. I now go up to, I believe, 20% at the very top of the screen. We may go up more. You know, the rise is pretty steep, but you can see in the past, you go from a steep rise to a steep decline. So I would expect it to level off. I don't expect to maintain 16% over asking price on a regular basis, but that's where we are right now. This is showing the 3 components over time. And you can see that the single family homes in Santa Clara County have been doing pretty strongly, but look at the change in San Mateo County. It's much more abrupt. Santa Clara County basically pivoted way back here at the beginning of October. You know, it was a gradual pivot. And then basically here at the beginning of December, it did an even steeper. And again, remember, these are closings. So if you closed at the beginning of December, you negotiate that offer at the beginning of November. Just a week or 2 later, the amount of overbidding went up dramatically. And that's just the way life happens sometimes. Here's the magnitude of overbidding in the geographical areas. Again, the concept, the redder the color, the hotter the marketplace. I go saturated red at 117.5%. And look at how many areas now are saturated. Milpitas, North Valley, Berryessa, Santa Teresa, Campbell, Cambrian, Santa Clara, Willow Glen, Cupertino, Sunnyvale, Redwood City, Bay Cities. So a good portion of this graph now is saturated red. I never thought we would hit 117.5%, and here we are at 118% and above. Here's the sold price, the median only. I do track, as you saw earlier, the 10 and 90 percentile, but I tend to put too much data on a slide. So this just shows the period over time. You can see the condo market in Santa Clara County really did a dip down for closings. I don't think this was property values. I think this was a market mix, what type of properties were selling. You can see that the vertical separation in between Santa Clara and San Mateo County is getting pretty close. It was much bigger here. It was also pretty close as the pandemic was announced. So there's been some back and forth fluctuation. These numbers should really be looked at logarithmically to do a comparison of the vertical spacing. Here is the map geographically of price. So if you're looking for affordable areas, Morgan Hill, East San Jose, and North San Mateo County are the most affordable. Then you got the area down here, Evergreen, Milpitas, Berryessa. Then you got the coast, as well as Santa Clara, Willow Glen, Cambrian, Campbell. Then you start getting into the median priced areas, Cupertino, Sunnyvale, as well as the Bay Cities. Then a little bit above is Foster City. More above is Saratoga, Los Gatos. And then the most expensive areas are Los Altos, Palo Alto, Menlo Park, Atherton. And again, the colors assigned by the median. And, between Los Altos and Palo Alto and Menlo Park, Palo Alto is actually more expensive right now by $10,000. But for 4 1/3 and $4.5 million, and not by $10,000, by $100,000. This chart I thought was interesting. Look how almost all the peak markets now are back on the left-hand side, which is the most current data. So this is the percent appreciation over 2020 pricing. So in the moderate low priced areas, Berryessa, Milpitas, Santa Teresa, Blossom Valley, prices now are 41% above what they were in 2020. You go down to Saratoga, Los Gatos, 41.5%. Those are just insane. And now, having said that, I just noticed Redwood City down here at 50% over 2020 pricing. You can see, I think every micro market area, so the furthest back you have to go for a micro market area is South County, and it was at 39%. You only have to go back to January 22nd. So that's again showing that prices are increasing. Here is looking at data. It's not an apples and apples comparison. It's looking at data from last night at midnight, going back 35 days for the 22nd, where all the earlier 21 years are basically starting on February 1st and coming forward 35 days. That's only until the vertical separation in 18. It was for 5 weeks, but I picked the 5 weeks that worked the best for the month. And then basically back in 2011, I was doing calendar months like everybody did. And there was a reason for the shift in how I did my data. I don't shift data for reason, and I debate quite a bit with myself typically before I make changes. The problem with a calendar month is there's a huge weekly and a huge monthly cycle. So the huge monthly cycle is why I was doing calendar months, because of the monthly cycle is bigger than the weekly cycle. That makes the most sense. As interest rates drop, the impact of the monthly cycle disappears and the impact of the weekly cycle becomes way more important. So I wanted to shift to 5 weeks of data. And then it was a matter of, once I shifted to 5 weeks of data, I initially did that to compare to the monthly data the best I could possibly compare to. And then that got confusing over time. So finally, I just started doing moving months, where I start on the first of the month and come forward 35 days, and that's my month. So on February data, it's not an apples on apples comparison. So like if you were to look at inventory right here at 440 and go, that's a record low by quite a bit, beating 615. 440 is going to come up because we got a whole nother 2 weeks almost. Well, we got 10 days left for it to catch 615. No, I don't think it's going to catch 615. Will it catch 500? Probably. It'd probably be right around 500. So it's going to be the record low, but not as record low as it indicates now. So you have to look at your current data and decide, is this current data going to go one direction or another by the time we get to March 8th? So now you move down to some things that aren't going to move as much. Median days on market, average days on market, 7 and 11, record lows. I mean, what can you say? 7 versus 8 isn't that significant. But when you start looking at 11 days versus 18 versus 20 versus 15, when the average days gets closer to median, it means you've been in a strong marketplace for a long time. Because if you've had a slow marketplace and then you heat up, you have properties that have been on the market for a long time, and when they sell, that pulls up your average. When you have no properties that are on the market for a long period of time, that's when the average gets closer to the median. And again, notice the difference between 4 days and 7 days. It's not that it's taking longer to sell the homes. It's because half the homes that were on the market last night had been on the market less than 4 days. So they came on the market this past week, and it's probably the vast majority. It'd almost be an interesting stat to track, and I would have to think about how to do this. What percentage of the marketplace of available listings was listed since Monday? DUI is the purple. That's the most important data point, in my opinion. 17 days. You can see that's a record low. I don't think that's going to change significantly. I don't think we're going to increase to 22.8. Now, can change. We have some world uncertainties going on right now that create the market to go in a different direction. No indication of that at the current moment. Then you look at the number of sales in the past 5 weeks, 902. Will it catch 925 and 927? Yes. So we're going to be selling more homes this year than we did back in 2020 and 2019, even though we have much less property. We probably have 50% less property and we're selling the same number of homes. So I don't know how many of you remember all the media stories and all the proponents out there going, we're finally, back here in 19 and 20, they were talking about the lack of sales, the low volume of sales was due to lack of inventory. Clearly not, because here you're now going to sell more houses with less inventory. So it clearly wasn't a limit back here if you're able to sell more with less. That's why I like what I do. I look at the quantitative marketplace. I'm looking at what the buyers and the sellers are doing and what their numbers mean versus trying to propound on why the market's doing what it's doing. I haven't found a model I like yet. For example, unemployment rate clearly impacts the real estate marketplace. Rate of change of unemployment is far more important, in my opinion, than unemployment rate, especially when it's in the positive direction. If it's in the positive direction, everybody's, positive being increasing number of unemployed, which is not a good number. Everybody's worried about who's next to get laid off. So the person that's still employed and still could get a loan isn't out looking because he's worried about getting laid off, where if the market's robust, even the person that's about to get laid off doesn't see it coming and is out buying a new home. It's all the matter. Basically, the sum of all the buyers and the sum of all the sellers out there is far smarter than any individual analyst, in my opinion, which is why I decided to do a quantitative instead of a technical analysis of the marketplace. Overbidding. This is really the hot point to some degree. The sale price is 116% of the list price on average. Here's your 112%. So that's clearly real close to the previous record. So it wasn't 110.8, it must be 112.8, but 116 is clearly way better. 86% of the sellers getting more than their asking price. That's a little bit better than 84%. Again, we're somewhat mirroring 2018. Yep, 2018 right there. Median price, 1.8 million. I mean, just a couple weeks ago, probably 3 weeks ago, this was like 164. So it's gone up $150,000 in just 3 weeks of closings. That's how rapidly the market changed with the beginning part of the year. Square footage is staying fairly constant. And here we have January data. This is January 1st data through February 4th data. This is looking in the rearview mirror to some degree because we're quite a bit past February 4th by this point, but I put it up there so we have an apples and apples comparisons. And you can see that, where we compare, we're outperforming 2018, both, by all the key indicators. And with that, I'm done. So here are the root URLs again. I'll pause and see if anyone has any questions. Not seeing any questions, I will call it a week, and thank you. Reach out with any comments, questions, how I can make this more interesting, etc. Thanks. Bye for now.